mine that database and try to see if there's new insights we could find. And what we found is that the papers, which will provide links to the papers in the follow-up email after the webinar, but we found that fund management was not the primary goal of most of these papers to kind of study that, but we did find some very interesting insights into fund management by doing these papers. So the goal today is kind of just focus in very narrowly on kind of the fund management space and kind of how it drives flows and returns. And the broader papers, I think, will also be interesting to this audience, but we won't really fully touch on that completely today. And with that, I'll pass it over to Kai.
All right. Thanks, Tim. So when Madison and I started thinking about the manager turnover paper at the beginning of this year, we were looking to answer one simple question. How does management change affect funds? As we started looking into the specifics of what we wanted to measure, this kind of evolved into three more targeted questions. How does management change affect outcomes or returns? How do investors react to management changes? And for how long do these changes persist through time? So to answer these questions, we built two models, one for investor outcomes and the other for investor reaction. For our investor outcomes model, or our returns model, we looked at gross category excess return in order to remove any biases for style and fees. For our fund flows model, we looked at organic growth rate. We also ran these models over 5 time periods, and we grouped together fixed income and equity asset classes. As for the data we fed the models, we looked at active equity fixed income funds domiciled in the U.S. from January 2003 to December 2016. We looked at this time interval because we felt that our database had the best coverage for the data points we were looking at. All the variables we used were calculated at the fund level. So any share class variables we rolled up to the fund level using asset-weighted values and equally weighted values as well. And any missing data that we found was imputed to the median by the date and category.
So before we go into our findings of how do management change affect outcomes, we wanted to stop and explain a little bit about how we defined management change and how we constructed this variable. So through looking at our database, how we define this variable is looking at an addition or removal of a single or multiple managers to a fund. And so we constructed it this way because this was our definition of management change. So the team that's running the fund has changed. And so then we decided to bucket these events into historical time periods. So we know that the effects of management change is not going to be immediately felt. So we bucketed it into 4 different time periods: 0 to 3 months, 4 to 6 months, 7 to 12 months, 13 to 24 months. And so by doing this, we can let the data reveal if there's any relationship between management change in the past and forward growth rates and forward returns. So when we look at the variable change, the variable management change 4 to 6 months, what this is saying, it's going to be the average change in flows or the average change in returns given a management change that happened 4 to 6 months ago. So then we wanted to dive a little bit deeper into types of management changes. So the previous variables describe on average what happens, but we wanted to know, hey, if this was a large fund at the time of change, or this was a successful fund at the time of change, are there different effects? And so we constructed these variables, alpha at the time of management change and fund size at the time of management change.
For this slide, we wanted to provide an example of how we interpreted our regression results and how we're going to display our data in this slide and for the slides for the subsequent slides in the deck. So looking at this chart, we see that along the y-axis we have percentile points. Along the x-axis we have time intervals for management change. So, for example, if we are looking at two funds, one experiencing management change and the other one isn't, what we see from the rightmost bar is from the fund that experiences management change, it will actually drop to the 49th percentile in terms of organic growth rate, whereas the fund without management change will stay at 50. And as we follow this effect to the left, over 12 months, the fund that experiences management change will actually drop to the 48th percentile in terms of growth rate, while the fund without management change will remain at 50. So in subsequent slides, we're actually only going to show the deltas in percentile point changes and not the actual ranking.
And I would also add that in this example of two funds, these are the two funds with exactly the same characteristics. So this is a regression model. So when we're doing comparisons, it's like holding all things constant, this is what happens. So if you have two funds that are basically exactly the same and one has a management change and one doesn't, this is the effects. And we're seeing 1 to 1.5% changes in percentile.
So moving on to the efficacy of our models. So one way that you can judge that is through the R-squared of these models. And so what we're looking at here is the R-squared of the returns model and the flows model for the 1 month all the way up to the 36-month model. And so what we see is that there's pretty much no relationship between management change and future returns. The model has an R-squared of roughly 0.6. So there's no way that we could construct this model to find a meaningful relationship between management change and future returns. However, when we look to the growth rate model, we find that there's very significant relationship. And so when you add in controls for fees, size, and past performance, along with these management change variables, you'll see that there's about a 10% relationship between those variables and forward growth rates.
I guess I would just add to this that I think this is probably one of the most important slides in the whole deck, because R-squared is really, you run a regression, the R-squared output tells you how well the data fits, the independent variables, how they fit your dependent variable. And to get an R-squared of 0.6, I was actually incredibly surprised at this result. The fact that, with all the different ways we looked at the data, we couldn't create a model that had any impact on returns, essentially saying that management change on average has no effect on returns for the average fund. And that doesn't mean there aren't plenty of examples, anecdotal examples where a management change really did impact returns of a fund. But on average, management change does not really, we can't find any relationship to management change and returns. And I would even say further is that you could take a bunch of random data and run a regression, and you'd often get an R-squared higher than 0.6. So it's actually pretty incredible that this number is so low. And then onto the growth rate side, so 10% R-squared, may not seem like all that great. If you run other types of regression models, and maybe you expect, R-squareds of 70% or 80%. I would say, though, when we do look at fund flows models, 10% R-squared is actually pretty good. And the main reason is that with the fund flows data that we have, now while Morningstar does have the best data, we don't necessarily have all the distribution data. So the most important factor to drive fund flows is if a fund is on the right platforms. So is that fund in the right 401ks, the largest 401ks, where they're going to get consistent flows just because they're in a very large company 401k. Morningstar doesn't necessarily have that data right now, and that's actually something we're working to try to fill out our database and get that data, because that'd be very valuable information for us for looking at the fund flows information. So because we don't necessarily know exactly what platform every fund is on, it does lower the R-squared of the regression. It doesn't mean the results aren't significant, and it is all these results we're going to show are statistically significant, but it does limit our R-squareds a little bit. So that's one thing to keep in mind as we kind of go forward here.
So looking further into management change and growth rates, we find that investors tend to overreact by withdrawing their money from funds experiencing a management change. So for example, if we look at the leftmost group of bars, if we look at the green bar, this tells us that if a fund experiences a manager change in the last 3 months, it's actually going to drop 2.4 percentile points in the next 6 months. And as we look at this change through time, we can see that this effect is both persistent and consistent.
We'd also like to add is that all of these effects are very statistically significant. And so while you might not say, oh, 2% in terms of category growth rate is not huge, these are, they're persistent, and that, you will see this effect.
Now looking at alpha. So the alpha variable we constructed here is actually just a one-year alpha. Now, one-year alpha is not something we'd normally judge a fund on if we were actually going to rate a fund, but we used one-year alpha here because we thought that, we're just trying to see what the most recent returns are. And so this interaction we do between alpha and management change shows that, because all these numbers are positive, is that if a fund has strong alpha over the last 1 year, if there's a management change, the fund is given the benefit of the doubt. And so these positive effects are actually help negate the negative effects from the previous slide. So this doesn't mean that if there's a management change on a fund with high alpha that the fund actually gains money. It's actually, since it's in the regression, you can sort of have to add these effects up to get to the final answer. And so this is a positive number, which helps negate the larger negative numbers from before. So I would say is that the positive effect is strongest earliest on at 3 months, and it does taper off pretty quickly over 6, 12, and 24 months, but still is positive and statistically significant. Next slide is fund size. So this looks at the size of the fund interacted with management change. So these effects are all negative over all the different time periods, which essentially says that the largest funds, if there's a management change, take a disproportionate amount. The effect is much larger on a larger fund. Now, this is not necessarily just because there's more assets, because remember our variable for growth rates is actually it's a growth rate. It's not a dollar value. So it's not saying that there's more dollars come out. It's actually it's percentage terms. So a larger fund actually loses in a higher percentage of its assets with the management change. And so there's we have a couple of theories on why this may be. I think the biggest reason I think is that when there's a management change at a very large fund, it gets press coverage. And the prime example of this would be Bill Gross with PIMCO Total Return. When Bill Gross left that firm, that left the fund, obviously there was news stories constantly for weeks, if not months. And there was stories updating investors on the flows of the fund on a monthly basis. I was here at Morningstar at that time, and I worked on fund flows, and I was continually updating the Wall Street Journal on what PIMCO Total Returns flows were. And just all that press coverage is only going to drive more negative flows. And that's kind of one of the reasons why PIMCO is trying to kind of change the conversation in many ways, because the more they talk about it, the worse it gets. And we saw incredible outflows out of that fund, which really driven by mainly the press coverage. So that's kind of why we think we see this larger effect for larger funds. Back to PIMCO Total Return, I also would note is that we did look at PIMCO Total Return as kind of an anecdotal evidence in this. And while PIMCO Total Returns flows were very strongly negative, we did not really see a change in performance for the fund, despite the, $80 to $100 billion in outflows that the fund took in like a 1-year period. So PIMCO Total Return is a really nice example for our papers. It's kind of a good example of something where larger fund, more outflows, but also didn't really affect returns.
We also wanted to look at, we also wanted to see if industry experience of the manager being added or removed had any effect on the growth rates or performance of the funds experiencing manager change. And in conclusion, we found that there was really no effect. So looking at the data, we see that in the bold, the numbers that are bold indicate that the effect is statistically significant. And as we can see, only two of the numbers are bolded. And of the two that are, they are very close to zero. So what this tells us is that this effect is also doesn't really have an economic significance as well.
And again, I think we'd like to point out is that it's really hard to run a regression and to have the coefficients show up as 0 to 3 decimal points. And so, we see that changing, the industry experience of the fund, again, is not affecting the forward performance. So what we have here on the next slide is just a number of the takeaways that we found throughout the paper. They just mostly summarize, what we've talked about so far. So that concludes our discussion of the effects of management change on flows and on performance. And so I think we'd like to move on to some of the other papers that we wrote about flows and really highlighting the manager effects that we found in each of these models. So to get started, we're going to talk about what we call a new fund success model. So what we're trying to do is forecast if a new fund is going to be successful. And so we did that in 2 ways. We looked at, given a new fund, forecasting their forward 36-month flows, given a new fund, forecasting their 3-year star rating. And so new funds, there's not a lot of data about them. They don't have a performance track record to rely upon. And so what we were doing is really just using the data that's available in the first 12 months and seeing if there's any relationship to forward flows and forward returns. And so what you do have is you have a lot of information about the firm that the fund is being launched from, the management team of this newly launched fund, the category it's being launched into, and the economic environment of the time. And so the one that we're going to focus on is the management team. So 2 ways we looked at management team was by looking at whether or not a new fund was being launched with managers who had their CFA and managers who were investing in the fund. And so we looked at both of these effects on forward flows and forward star ratings. What's interesting is that, again, all of these effects are statistically significant, but the effects on flows is much higher than the effects on star rating. And so investors really prefer new funds where the manager invests in it and where the manager has a CFA. And so both of these two are signals to investors that, hey, given a lack of information about a new fund, I do know that my manager has, CFA is a proxy for education, so they have higher education, and they believe in the fund by investing in it. And so that's why you see these much larger effects on flows. As well, you do see that managers who invest in their own fund and do have a CFA do have slightly higher returns, but investors gravitate to it more than the actual effect on performance.
And I guess I would just add that, some people have asked me after doing these papers, well, like, how do we tell someone has a CFA? Well, normally it's relatively easy. People with CFAs typically put it on their, it's on usually in the prospectus, and oftentimes the company's website will also, people want to publicize that they have a CFA because it is a sign of education. So it is usually relatively easy to see. But again, I think this paper kind of lines up with the previous paper where we see flows as a much bigger effect than we see with star rating, which star rating is the proxy for returns. So again, returns the effects are not as strong on the returns of a fund versus the flows of a fund. Moving on, next third paper we're going to quickly touch on is factors driving fund flows. This paper came out in 2015, and it was a broad-based paper looking at the fund-specific drivers of fund flows. We did not look at necessarily, this was not looking at new funds or old funds or anything like that. It was more just looking at the entire universe globally of all funds and looking at their organic growth rates. That's what we were trying to predict. and we grabbed, I think the final model had over 20 different independent variables. And the ultimate goal was extracting what are the factors that drive flows into and out of funds. And I would highly recommend you kind of check out the paper because there's a lot of insights in there. And actually, we're working on right now an update to that paper, which will hopefully be out in the next month, with all new data updated for in the most recent time period. But the one part about managers in this paper was the effective manager tenure on flows. So this chart shows you the effect of how much positive or negative addition or subtraction to your growth rate you got from the number of years you were a manager on the fund. So if you had 0 years of management on the fund, that actually drove a negative 2% organic growth rate, which is a very large effect. Negative 2% is a huge effect, which then other factors could potentially counteract that with 20 other factors. But very, very large penalty to being a new manager. Now, conversely, if you're a very long tenured manager going out over 20 years, you can get to over positive 0.5%, and then potentially, if this scale here really kind of skews, but going out 30, 40 years, you can get close to 0.6, 0.7% positive effect just for being a long tenured manager. So this is kind of where we can see how when we have back to the management change paper, if you have if you have a 20-year tenured manager, you're going to be getting over 0.5% a month on positive flows because of that. That person retires and you hire a new manager, that takes you from positive 0.5% all the way down to negative 2%. So management change, is a big deal in the industry, and fund companies do try to avoid it because they see these effects. Now, there's not much you can do. People do have to retire. That's why we see a lot of funds today, as you have a long tenured manager, they will start to add other managers to the fund to try to build up some tenure, to build up the younger managers' tenure on the fund, so they don't get to a situation where they have a single portfolio manager run fund with retirement, and then there's no one with any experience on the fund, because investors do not like that. So that's why in any of your funds where the manager's been around for 10 years or more, you're likely to see them, a fund company, add a manager as a co-portfolio manager to kind of counteract this effect. And moving on, that concludes our prepared remarks. So hopefully it was interesting. We think there's a lot more insights if you end up checking out the papers. At this point, we'll take some questions. So we'll pause here for a minute to kind of gather questions.
And just as a reminder, you can go ahead and submit those in the Q&A chat box through WebEx.
So we have a couple questions. I'm going to read them out for Tim and Kai. One question was, so you looked at industry experience, but did you also look at the team size, so the number of managers on the fund, or did you also look at when the team swaps out completely?
Yeah, we actually did. So the end result of the paper was any management change, addition or subtraction count as a management change for the paper. But we did get feedback from internal stakeholders that we should look at if the entire team leaves, or how that would affect the model. And we did this, and it didn't change any of the results. And then we had, there was probably 10 different iterations of this, people suggesting different ways to look at management change. And we tried them all, and invariably there was no effect. There's no different than the results we've kind of showed you here today.
A couple other questions. So did you, account for survivorship bias? So for all of these papers, we are using, the full historical set of funds that were around at that time. And so when a fund, dies, they are included in the study until the point that they become obsolete, and at which they do drop out. We do run these models through time, and so they're included in there for the time that they're alive.
So there is no survivorship bias in any of these papers.
Another question is, did you look at other types of education levels besides CFA? And so I actually looked into some of our degree data. So we have the degree of the managers, what school they went to, what year it was, and we found that it wasn't comprehensive enough to include in the paper. And so that we felt that our certificate data, such as CFA, CFP, was much more complete, so that's why we went with CFA. Another question, did you compare different asset classes, equity funds versus fixed income funds? So for the manager change paper, the final result was we decided to group equity and fixed income together. We, in previous iterations, had separated the two asset classes because we might have expected the effects to be different for fixed income than equity. But we found that they weren't, and so because of that, we decided to group the data together. Another question, maybe this is for Tim. What positive outcomes, if any, are achieved by manager change?
That's actually a very good question. Well, so just looking at the results of our paper, there aren't any from the way we looked at it, was we just looked at performance and flows. So based on that, I'd say there's not. And that doesn't mean you should never have a management change. There are obviously plenty of reasons that you would want to have a management change. But it seems that on average that when funds do change managers, it doesn't necessarily improve results. Which is part of the reasons why you may see that there's so much turnover in the industry as far as funds, why so many funds are opened and closed, because if you have a poor performing fund, if you could just change the manager, and that was something that would likely increase the returns going forward, which would then increase flows, you would just do that, because it's much easier to change a manager than it is to close a fund and open a new one. But since fund companies have probably noticed that changing managers doesn't really impact returns, that's why they just close these funds down and then launch a new fund, and it's much easier to sell a new fund that has no track record than an older fund that has a bad track record.
Another question for the fund flows paper, what factors on fund flows? Is manager tenure distorted by fund age or survivorship bias? So I believe in that paper, Tim, correct me if I'm wrong, one of the other factors that we did not talk about today was fund age. And so by adding fund age, we are controlling for the different levels of how long a fund has existed. And so the manager tenure piece should be everything that's in addition to fund age.
Yes, that is correct, Madison. And actually, the fund age variable in that model was actually very negative for the older the fund was, the bigger a negative effect it had. And that just speaks to the fact that the industry is very short-term driven, and the newest funds tend to get the highest flows. I don't know that's well, people don't necessarily notice that all the time, but if you just look at the flows into funds with less than 3-year track record usually get higher flows than anything else, because when you launch a new fund, you have a wholesaling team, a marketing team that goes out and tries to sell that fund, and you're selling hope, and it's much easier to sell hope than it is necessarily to sell something with poor or just average performance. Now, obviously, with the funds that are successful, those sell themselves. You don't need a wholesaler to sell a fund that's had strong positive alpha for 5 years. That people find those out very easily just by doing searches into our Morningstar products.
Another question, did you account for style/category effect in your regressions? So for all of these papers, manager change paper in particular, the data is standardized by category. And so for the returns model, we're forecasting gross excess returns. And so that's our attempt to control for the different style biases by different categories. And for the organic growth rate model, those growth rates are standardized by category. So we know that there are certain categories that get more flows than others. So that was the way we accounted for that.
And that's done through any paper that we do. We always standardize at the category level because there are very clearly different effects in different categories.
Another question. So We did not run the study on alternative funds. It was just on equity and fixed income. Do we expect the significance to be greater in the alternative space for the management change paper?
Interesting question. Alternatives are kind of a weird bird in the sense that they don't, and when we've studied alternatives, they don't seem to react the same way as how you expect a regular typical equity, fixed income, or balanced fund. They're also a very new category. They really haven't been in wide adoption, since adoption started probably in 2007, 2008. So we don't have as much track record. So we didn't look at it particularly. So I guess I would just be guessing. But I would expect the flows into alternatives tend to be more volatile. Investors don't seem to stick around as long as they might into an equity or fixed income fund. And I think that's mainly due to the fact that alternatives, as being relatively opaque and sort of like a black box, that if you don't understand where the returns are coming from, you're less likely to stick around when returns become poor. Whereas if an equity fund, if your value fund is underperforming, you may stick around longer because okay, well, value stocks haven't been doing as well, so it's not necessarily the fund or the manager's fault. But so I would expect that in alternatives, we'd see much larger effects on the flow side. I doubt we'd see any effects on the return side, but definitely on the flow side, we'd likely see a larger effect.
So I think that's all of the questions that we had so far. Thank you for all participating. Those were great questions.
And so that will conclude our presentation for today. We will be sending out a replay of today's presentation. So you should be receiving that within your inbox within a few days. So thank you again for attending. We appreciate your time and hope you enjoyed the presentation today. Thanks so much.